Hello everyone, welcome to this video. Today I'm going to show you how to build a complete financial model in a Microsoft Excel. For a small business here, especially we are taking a cafe startup. In this session, we will forecast sales, costs, and profit, and finally estimate the value of the business using discounted cash flow method, also known as DCF. The goal is to demonstrate how financial modeling helps small business owners and students understand the financial health and valuation of a company. All this in a single simple Excel sheet. So let us begin. First, let us take some assumptions. Here, for that, we will be taking some particulars. So these particulars include units sold, price per unit, cost per unit, fixed costs. We'll also take tax rate, discount rate, and terminal growth. These three tax rate, discount rate, and terminal growth are something that we will use in the while calculating free cash flows and doing the DCF method. Also, along with this, we will assume some growth rates for unit sold, price per unit, cost per unit, and fixed cash cost. These are. Let us assume that unit sold will be increasing by 10% year on year, price by 5%, cost by 5%, and fixed cost by 8%. Now, using these values, we will be able to forecast the data for year 2, 3, 4, and 5. And for the first year, let's assume that we will be selling 1 lakh units. And let us say that price per unit is 120 rupees, cost is 50, and the fixed cost would be 10 lakhs every year. These fixed costs comprises of all the expenses regarding rent, electricity, and salaries. Now, let us assume there is a tax rate of 30%, discount rate of 12%, and terminal growth of 3%. Now, to find the units sold from year two, we will be taking the units sold in previous year multiplied by 1 plus the growth rate of units sold. Let us freeze the growth. Now, by dragging this till year 5, we will be finding the growth for year 3, 2, 3, 4, and 5. The same way, let us do for price per unit. That is first year, first year into 1 plus the growth, freeze it. Now, this is it. The same way we will do it for cost per unit and fixed cost. Now we have got the required data for our next step where we will be finding the revenue, gross profit, net profit, operating profit and everything. So for this, let's take the following particulars. First is revenue, cost of goods sold, gross profit, fixed costs, EBIT, essentially the operating profit that we will get, tax amount, and net profit. Now, let us take let us find out the revenue. So to find revenue, we will be multiplying units sold by the price per unit. Now dragging it till year 5, we will be getting the revenues for all the years. Next, in the same way, let us multiply units sold with cost per unit to get the cost of goods sold. Now, gross profit is essentially revenue minus the cost of goods sold. This is our gross profit. Now, let us take the same values for fixed cost from the above table. Using this, let us find the operating profit or EBIT. So this is basically gross profit minus the fixed cost. Dragging it till the 5th year, we have got the operating profit for year 1, 2, 3, 4, and 5. So next for the tax rate, tax amount, as we have already assumed the tax rate to be 30%, we will be taking the EBIT value into tax rate. Let us freeze the tax rate so that it becomes easy for us for calculating the remaining years. Now we have got the tax that we will be paying for years 1, 2, 3, 4, and 5. Next, let us find the net profit. To find the net profit, we will be taking EBIT, then subtract the tax from EBIT or operating profit. So now we have got the net profit or profit after tax for the 5 years. Now, using these revenue and profit, using this net profit, we can find the free cash flows. So next, let us calculate the free cash flows. So why we should calculate free cash flow is because free cash flows represent the actual cash generated by the business after paying for the operating expenses and investments. So this is a key metric because it shows how much money is available with the owners or investors after covering all the costs that has incurred. So let us calculate that. Now, here it has particulars like net profit, discount factor, we will not have a discount factor here. We will be having a depreciation here and capital expenditure. And using these, we can find the free cash flows. Now here capital expenditure is basically the capital that will be injected into the firm year on year. Now let us take the net profit as same as from the previous table. Now let us assume that the depreciation is constant at 2 lakhs per year for the ease of calculation. Also, we like assume that the capital expenditure is also fixed at 3 lakhs for the ease of calculation. Now, use, using these three datas, we will be finding the free cash flows. That is net profit plus depreciation minus capital expenditure. Now, by dragging it till year 5, we have found out the free cash flows for year 1, 2, 3, 4, and 5. Now, using these free cash flows, let us find the discounted cash flows. Now, why we are using this discounted cash flow is because money today is worth more than the same amount in the future. So we need to discount the future cash flows back to today's values. So to do this discounted cash flow, we will be using the 12% discount rate that we have taken in the first table. So let us do it now. So here we will be taking particulars like FCF, that is free cash flow, discount factor, present value of free cash flow. Also here we will be taking values like terminal value and present value of terminal value. Now, let us take the free cash flows the same as from the previous table. Now, for calculating discount factor, we will be using the formula 1 divided by 1 plus discount rate power the year. So we have found out the discounting factor for year 1. Let's freeze this for ease of calculation. Now let us do the same thing for year 2, 3, 4, and 5. Now, to find the present value, we will be multiplying the free cash flow with the discounting factor. Now, we have got the values for all the discount. We have found the values for present values for all the free cash flows. Now, let us find the terminal value. So, terminal value is basically represents the value of the business after the fifth year, assuming it continues growing at a rate of 3% per year indefinitely. So, for terminal value, we will use the formula of FCF at year 5 into 1 plus terminal growth divided by discount rate minus the terminal growth. Now we have found out the terminal value. Now, in the same way as we did the present value for free cash flows, we will find the present value of terminal value. That is terminal value into the discounting factor of year 5. Now we have got our terminal value. So from these data which we have calculated, we can find the enterprise value. Here, the enterprise value is the estimated current value of the cafe based on its future earning potential. So, to find this, we will do we will be taking the following particulars. Here we will be taking total of present values of free cash flows, present value of terminal value, and using these two values we can find the enterprise value, which is basically the value, estimated current value of our cafe. Now let us first find the total of the present value factors of present values of future cash flows, sorry, free cash flows, that is summation of present values of free cash flows. Next, let us take the value of terminal value, and to calculate the enterprise value, we will be adding the total of present value of free cash flows with the present value of terminal value. Now we have got the enterprise value of our firm. Let's just highlight these so it is easy for us to get the find these things. Okay, now we have completed a model for finding the enterprise value or the valuation of a small business. So let us see how this works if we change any value in these models. So first let us take that instead of 10% growth, let us take 20% growth for the units sold year on year. Now see, as I have changed the value from 10% to 20%, the values started changing starting from year two of the first table and all the way till the enterprise value. Now, as you see, the enterprise value has increased from 6 lakhs 96 crores 98 lakhs in the when we did in the previous scenario to the current scenario where the value is 9 crores 81 lakhs. The same way, let us try changing the units sold from 1 lakh units to 2 lakh units. Now, see the change in the value. See how much it has increased. So this is how this model works. So by having this model, we can find the enterprise value of a firm by just changing one or two units, and we can find all the we can find the free cash flow, the net profit, the terminal value, and also and what will be its free cash flows. Everything we can find through this. So, and that brings us to the end of this one sheet financial modeling exercise. So, to recap what we have done in this video, we started by defining some key assumptions for the business, and then we have calculated the revenue, the cost of goods sold, gross profit, and net profit. Also, we have found out the free cash flows, and then we used a dividend discount. Then we have used a, DCF model to find the uh, present value of FCF and also the present value of terminal value. From these, we have found out the enterprise value or the fair worth of our company. So, so from this you can see how powerful a simple financial planning tool can be, and this can be and models like this can be used by entrepreneurs, analysts, or even students to understand how a business how we evaluate a business, and also helps us to find and helps the small business owners to keep a financial discipline. Thank you so much for watching the video.